All right, welcome back to today's class. I'm very happy you made it back, and I'm so happy you have made it thus far. You see, you keep it going, keep it moving, okay? You're going to get to your destination and have your license. On that note, we're continuing in today's class on chapter 6. You see, I'm very excited about this chapter, and I'm super excited bringing this to you, bringing all the following explanations supporting this chapter to you, because on the field, this is what we hear all the time. I have a group insurance. My employer provide life insurance. Do you think I need another one? Anyways, let's dive into today's class in chapter 6. All right, I thought I was defaulted to the chapter on my browser. Chapter 6, we will be looking at how group life insurance works. That life insurance you'll have at work. How does it work? That's what we're going to learn today. Okay, isn't that exciting? You see, the thing I love about this knowledge is that it brings so many things to life. Even me as an advisor, as a broker, you see, putting this class together is kind of, grounding my knowledge in this thing furthermore. Because when I wrote my exams, you know how you study just to pass the exam, but doing this for not just to pass the exam, but to pass knowledge across is exciting for me, even though very tasky. So that being said, have you taken a moment to subscribe? Well, consider it, right? It's your way of saying, okay? I'm just saying it. I'm just saying it. Even if you do or not, I still love doing this to support everyone that is going through the process of getting licensed. All right. Whew, let's continue how group life insurance works. How does it work? Do you know? All right. Note that this chapter only deals with life insurance provided by group insurance plans. The other benefits provided by group insurance is covered under the accident and sickness modules. Okay, we get that. That is straightforward. All right. Group insurance is insurance that is offered by a plan sponsor to a group of people who share a common association with the plan sponsor. Group of people who share a common association with the plan sponsor. For example, employees working for the same company, full stop. The policy holder, which is the company is the policy holder, and the same company is referred to as the plan sponsor. Okay, so the company is the policy holder and the plan sponsor. So the common association is that all the employees work for the same company and the employees are the lives insured. You got it? That's right. If you don't get it, don't forget about it. Like I always say, rewind, go back, and replay. All right? Cool. What constitutes a group? Group insurance can be made available to groups such as employees of a certain employer. The employer must have more than minimum number of employees as set by the insurer. Using the policy, usually 5 employees minimum. Students or alumni of specific universities or college. Professional associations members, such as members of the College of Physicians and Surgeons, society members, such as members of the Society of Automotive Engineers. For example, Helen is a university graduate with an engineering degree, and she is registered as a professional engineer with an occupational association. She is self-employed as a consultant and is a member of her local chambers of commerce. She has also purchased memberships with 2 retail associations because she is self-employed. She cannot obtain life insurance through her employer. You see, this is just typical, like Mary Helen is self-employed, so, but she's a member of Association of Engineers and blah, blah, blah. Like me now, I'm PMP certified, I'm a member of PMI. So PMI have insurance plan for all PMI members, okay? Though I didn't take through that because I have my personal life insurance, so I don't need the one through PMI. Right? So that's typically what you're talking about. So when you are working for an employee, also giving an example of myself, when I was working for General Electric, I was part of the plan. I had life insurance through work provided by GE. And in that instance, GE was the plan sponsor, okay? And I'm the life insured, all right? And GE is the policy owner. Okay, Gary, awesome. So now that we've explained, so now take a second and then reflect on this with your current employer. Who is your current employer? See that employer as the plan sponsor, the owner of the policy, and you are the life insured. And the relationship that enables you to be the life insured is because you belong to that common group, which is as an employee, or you are a member of an association or a professional group, and you are able to take life insurance through your professional association. What is the name of that your professional association? Is it PMI? Is it Society of Civil Engineers? Is it Society of Accountants, or whatever it is? That organization, that society is the plan sponsor, and you are the life insured. All right. So now we're moving on to the further explanation of plan sponsor, policy holder, and stuff like that. Now, the policy holder is also called the plan sponsor. A plan sponsor can be almost any organization, society, or association that enters into a contract with an insurance company to provide life insurance coverage to the members of its group. Plan sponsors divide its group into subgroups called membership classes. All right. So the plan sponsor, which is now, take for example, organization, right? Divide its members into classes, into subgroups called membership classes, and each class receive insurance coverage appropriate to its needs. For example, within a company, executives may receive higher coverage reflecting their higher level of income than the coverage received by its factory workers. Okay, yes. You understand what everybody, you see, in the organization doesn't receive the same coverage, okay? Like when I was with GE, I was covered up to the maximum, I was covered for 500K, right? But I'm sure my boss and my boss was covered for way more than that, based on, number one, their salary and the number of years they have invested into the organization. So all those things are things that are often detailed in the offer letter, right? Then now we see what who is a plan sponsor, right? And we've understood that the plan sponsor, who could be an organization, a society, whatever, also subgroup its members, group its members, divide its members into subgroups and classes based on their appropriate needs and qualifications. Now, master contract. A policy is issued by the life insurance company to the plan sponsor as a master contract. You see, like when an individual get their life insurance, you see they are sent a policy. It's called a contract, right? And that's why I tell people every time we are filling out insurance application and they're like, oh, Joy, all these questions are too much. Do we have to answer this question? Oh, yes. Do you know why? It's because it's a legal contract document. So we want to make sure everything is done correctly, right? So as an individual, you are sent your individual policy contract, right? Now, for an organization like GE that have employees, so many, or consider your organizations. Are you working for the government of your province, or are you working for the federal government? Whoever your organization is, do you think the insurance company will be mainly individual policy for each of their employees? No. Just one contract is issued for that organization to cover the whole employees or members of the association. And that individual policy document is referred to as master contracts. Awesome. Okay, the plan sponsor is the owner, the manager, and the manager of the policy for its members. It is responsibility. It is responsible for paying premium and making decisions regarding the policy. Oh, yes. See, this plan sponsor, which is now your organization, right? Or is the owner of the policy. So as the owner of the policy, it is your organization that is responsible for paying the premium and also responsible for making decisions regarding the policy. Now, the master contract ensures the sponsor's employees or members, they are called the plan members. Okay, so now the plan members are the employees, just simply put, okay, so that we can move very quickly. The plan members have no direct contact with the insurance company. That's right. They also have no control over the policy aside from naming the beneficiary and buying optional additional coverage if the plan permits. You see, the plan members, which in this case, the employees or the members of the association, have no business, have no connection, have no communication, have no, any direct contact or whatever with the insurance company. The only thing they do is by naming their beneficiaries or buying additional coverage if the plan is structured in a way that they can do that. Group members do not receive a copy of the master contract. I've talked about that. Group members don't receive a copy of the contract. They receive a benefit booklet that summarizes all the insurance benefit and rights under the contract. Yes, what they get is a benefit, is a booklet that summarizes their rights and their benefits under the contract. All right. Okie dokie. We move on to group membership. Now, the plan sponsor establishes eligibility for membership in the group plan. To obtain coverage under the group plan, the plan member must meet the criteria of eligibility that defines the group. Okay, there are 3 types of membership in the group plan. Number 1, optional membership for association members. In this case, the members choose to join. Members must be a current association members in good standing, and members who leave the association may be able to convert their policies to another form of insurance that will be personally owned. 2, optional membership for employees. Okay, so there's optional membership for association members, then optional members for employees. The employees choose to join and is required to pay portion of the cost of the insurance. This is called a contributory plan because the members contribute towards the premium. An employee can enroll the plan after can enroll in the plan after satisfying the group's probation period. The probational period, also called the waiting period, is the length of times an employee must work with the employer before becoming eligible for group insurance coverage, usually 3 months. Upon becoming eligible, an employee has a limited amount of time to enroll in the group plan and obtain life insurance coverage without providing any evidence of insurability. This is referred to as enrollment period. Okay, so there's what we call optional. That is it word, right? Optional membership, before an organization where when a member choose to join, say optional members for an organization, members choose to join, and you have to be in right standing. For some organizations, you have to pay your annual dues. Your annual dues have to be up to date to be in right standing, okay, to be able to take advantage of this golden opportunity. And then the second option is optional members for employees. So for this one, most of the times, employers set criteria, which is you must have to meet your probational period before you can be enrolled into the plan. And in most cases, the probational period is usually 3 months. And after that 3 months, the employee have the opportunity to enroll. And the employee must enroll into the plan within a specified period of time. Okay. And then upon becoming eligible. All right. Now, the period that upon becoming eligible, an employee has a limited amount of 10 years to enroll without providing insurability. And this period is referred to as enrollment period. Okay. That is the period that the employee become eligible. That is, if it's 3 months probation period. So the period that the employee meets the 3 months criteria and the period that the employee enroll is called the enrollment period. All right. So we move on to actively at work requirements. So now we've seen optional enrollment for an organization. We have seen optional enrollment for employee. And now we are looking at actively at work requirements. So when the sponsor is an employer and the employee must be at work on the day his coverage in the group plan is to begin. If the employee is away from work on the scheduled date, his coverage will not begin until the employee returns to work. Okay, very straightforward. Now, membership classes. Remember how we talked about the plan sponsor or an organization, kind of group the employees or members of the organization into membership classes at the beginning of this chapter, right? Okay, so that is what we are going into looking at right now. Okay, some employer-sponsored plans have more than one membership class within a single plan. Labor criteria administration and management are examples of the different classes that may exist in a group plan. A schedule of benefits as stipulated in section 621 applies to each member of a membership class. Membership classes differ from one another in their coverage. That's right. The membership class for a managerial role definitely will be different from the membership class for administrative role or labor kind of, For example, the DEF company manufacturer of kitchen cupboards sponsors a group insurance plan for its employees. The plan provides death benefits equal to one-time salary for all full-time factory floor employees and two-time salary for all salaried managerial staff. You see, this is an example. You see, those on the floor, they get one-time salary coverage, and the managerial staff that are full-time get 2 times their salary. Okay, this is just telling us an example of what? Membership classes. Okay, we move on to premiums. Okay, premiums for group life insurance are based on the average characteristics of the group. Individuals are not singled out. For example, if the insurance company charges 0.220 for insurance, that rate will apply to everyone in the group, regardless of the age, gender, or health. You see that? It's the same. And that's why some people that are not able to get policy for themselves as an individual are able to get it through the group. Okay. Now, the insurance company recalculates the premium every year. Changes are made to reflect changes in the group's dynamics or demographics. For example, due to an increasing older or younger workforce, premium will change. Most plans require the employer to cover at least 50% of the premiums. An employer may pay the full amount if they choose. For contributory plan, the employer pays the full premium to the insurance company and then deduct the employee's contributions directly from their pay. Tax treatment for employer. Premiums paid by the employers are tax deductible as a business expenses. Tax treatment for employee, that's straightforward, right? ABC company insures their staff, and then maybe the premium for their staff every month is $50,000. Let's say ABC companies pays 25,000, which is half of it every month. And then all the employees, the deductions from all employees based up is 25,000. So the 25,000 that ABC company pays every month for the employees' life insurance coverage is tax deductible to ABC company, which is really cool. And then what is the tax treatment to employees? Now, premiums paid by employees on behalf of group members are a taxable benefit to the employee. Premiums paid by an employer. Okay. So now, get this. Premiums paid by employer are tax deductible as a business expenses. Now, premiums paid by employer on behalf of the group members are taxable benefits to the employee. Okay, so you're going to see that amount. I don't know how is the way organization will show it or treat it might vary, but it's going to be a taxable income. For example, if this person maybe actually earns 50,000, okay, and then the company pays $100 on this person's behalf, that's 1,200, right? So it means that this person's taxable income will be 51,200. Okay, so it's a taxable benefit to the employee. All right, premiums paid by employee are not tax deductible. Yeah, premiums paid by employees are not tax deductible. However, death benefit paid by the policy are tax-free to the employee. Do you understand? Okay, let's read the examples. If the example is not getting us there, I will re-explain. Okay, so because there are 3 things they say here. Premium paid by the employer is tax deductible to the business. That same premium that was paid by the employer that is tax deductible to the business right, is taxable benefits to the employee. Okay, then the premium paid by employee is not tax deductible. However, the death benefit paid by the insurance company to the employee in event anything happens is tax-free. Okay, so let's look at the example. Amy is a member of her employer's group life insurance plan. The annual premium for Amy's participation in the plan amount to $500. That's the annual premium participation. The employer pays 60% of this premium, which is $300. And this results in a taxable benefit of $300 for Amy, who should be added to her annual income. You see, the employer also deducts $200 from her pay to cover her share of premium. All right? You get it now? Okay, so now this $200 that Amy pay is not tax deductible. No, it's not. But the death benefit pays to Amy if anything happens to her is tax-free. All right. Now, the company pays $300. This $300 is tax deductible to the business, which is seen as business expenses. However, the $300 to Amy is a taxable benefit. So if Amy is earning 50K, so at the end of the day, her income line taxable income will be 50,300. Okay. All right. Now we move on to sales tax on premiums. A tax on premium is charged by the provinces or territories, the same as it is for personal policies. So tax ranges from 2% to 5%, depending on the province. Retail sales tax is also charged on premiums in Manitoba, Ontario, and Quebec. So GST/HST. But for those of us in Alberta, we don't, okay? So group term, and that's why when we are completing or when we are running illustrations, there's always a place we have to choose our province, which kind of determine the tax rate. All right, group term insurance coverage. Insurance coverage is restricted by the term of the plan. A prescribed amount of base coverage is automatically provided to all members. Some plans provide members with the option to purchase additional coverage. Yes, that's true, but not all members, some members. So insurance is usually provided in the form of yearly renewable term, okay? Schedule of benefits. Now, the schedule of benefit describes the amount of coverage provided as the base. If a plan has different membership classes, then a different schedule of benefits will apply to each class. Coverage can be increased by one of the following 4 methods, okay? Earning multiples. So yeah, again, this is not an introduction of new principles. We've seen this, schedule of benefits, just the way we have groups and classes, organization group, their members into groups and classes. You have the managerial class, the admin class, the laborers class and stuff like that. So are the benefits in those groups, right? And that's what constitutes the schedules of these benefits, okay? Now, these benefits, some of them can be earnings of multiples earnings. That is earnings multiple. For example, the case study or the example we were given earlier where the managerial group are covered 2 times their salary, while the guys working on the floor are only covered for 1 time their salary. So that is earnings multiples, okay? Any multiples coverage uses the group members' base salary as a starting point and adds a multiple of that base on or a portion of that base. For example, the CEO may receive coverage equal to twice his or her salary, and the plan may specify a maximum coverage amount. Exactly. Let's say if this CEO receives like 250, okay, per annum. So it means times 2 of the coverage of the CEO will be 500,000. But what if the plan now have to a maximum, let's say to a maximum of 400K. So it means the CEO can only be covered up to 400K, right? Now, in another class or any categories or benefits, we have a flat rate. A flat rate coverage, every grant member receives the same dollar amount of insurance, regardless of position or salary, like a leveling ground for everybody, and everybody earns the same, which I feel is so great because, anyways. Now, length of service. Some organizations determine the benefit based on how much time individuals have invested into the organizations. Under the length of service schedule, coverage increases the longer the group member works. Okay. And then in some cases, we may see combination of both, right? Combination improves benefit by membership classes, like employees on salary receives earnings in multiple, hourly wage employees receives a flat rate. That's interesting and good to know. We move on to coverage maximum. Now, most plan places a cap on the amount of coverage so that no single member receives more than a maximum amount of coverage. Like the one I said before, a CEO that is earning 2 times, that is getting 2 times their annual salary as death benefit. If there is a ceiling cap, that is coverage maximum of 400,000 or 450,000, it means that CEO will only get that maximum. Okay, even though the 2 times salary is higher than the maximum. All right. Now, reductions for older or retired group members. A plan may reduce coverage for older or retired group members to control premium cost for the balance of the group. All right. Remember, the coverage provided is yearly renewable term, which is a principle we've learned in the previous chapters. Therefore, the yearly renewable cost for older members will be much higher than for those who are younger, and their higher cost can increase premium costs for all group members. Yeah, that everybody's level, whether male, female, health or unhealthy. You see, all the group members are, cost the same. So it makes it easy for people ordinarily who wouldn't have been able to get insurance through the umbrella of a group plan. But when you now have older people, because remember, the insurance company evaluate the group and see the experience of the group. The experience of the group is the actual reality of what happened, how many people dies in the group, how many premiums, death benefit do they pay in the course of the year. Those are the experiences that will make insurance company to determine how much they will charge the organization. So when an organization is getting higher number of older people, then the risk of having claims will be higher than an organizations with younger employees, right? Workers receives, okay, let me start from the first, this is say the amount of coverage older and retired workers receives may be reduced to a percentage of pre-retirement coverage or a dollar amount, or a gradual decline every year until a minimum amount of coverage is reached. For example, Carl is a member of his employer group life insurance plan, which provides a base benefit of 100,000. He plans to retire next year when he turns 60 years old. At that retirement time, his coverage will drop to 50% of the base coverage. At age 65, it will drop to 25 of the base coverage. And at age 70, coverage ceases completely. Wow. Optional additional coverage. Okay, so again, this is straightforward. I'm sure you get this, right? So let's move forward. Optional additional coverage 624. So I'm moving it on my own notes here. All right. You're wondering, oh, Joy, do you have a note? Of course, I have a note. It's a lot of work, lots of effort, my people, but it's all good. I'm glad to be here doing this to support all of you through this journey. Okay. Now, optional additional coverage. Some plans allows their members to add coverage to their base coverage. The additional insurance is an optional, not a requirement. Yeah. And the plan member pays the premium for the additional coverage. Of course, you want extra, you pay for the extra, right? The plan member must be enrolled in the group-based plan in order to purchase additional coverage. Proof of insurability is usually required. You see, these guys, you see, because when you are a member of the plan, right, you're not required. They don't test you, they don't check you, you're just qualified automatically by being a member of the plan. So now maybe you now want to use the opportunity to pile up additional coverage for yourself. Ain't going to happen, because the insurance company is going to require the proof of insurability to be sure you are healthy before they give you this additional coverage. Proof of insurability reduces adverse selections. Adverse selection occurs when those who have a higher probability of death, that is, those who are bad risk, choose to receive a higher amount of coverage if it is made available to them. If insurance was issued to those who would otherwise not qualify, then their correspondingly higher rate of death will increase premium cost for the group as a whole. Yeah. Now, proof of insurability is sometimes not required. In such cases, the additional coverage can only be purchased within a specified period of time. So again, where insurance company is not asking you to provide proof of insurability, well, they might give you a time frame that, okay, but you must take advantage of the opportunity to increase your policy within a specified period of time. For example, optional coverage can be purchased up to 60 days after the waiting period without proof of insurability. Again, do you remember what the waiting period is again? We talked about it. The waiting period is the moment that the employee meets the criteria and the time the employee actually enroll. Okay. All right, term coverage. Additional coverage that is provided is term life insurance. It is sold in units and members can buy as many additional units as desired up to a maximum. For example, the units could be worth 25,000. Now, spouses may also be covered with the same coverage units and maximum. Okay, that's good. There are a maximum number of units that can be purchased by the plan members and his or her spouse. Why add additional coverage? Again, so when you're adding additional coverage, the additional coverage that you're adding is a temporary insurance, it's not permanent. Okay. Now, why will you want to add this additional coverage? Oh, by the way, you can also add this additional coverage for your spouse. For example, The CEO is covered up to 2 times his or her salary, which is like 500,000. And this group plan allows additional coverage to be purchased. Now, this CEO might decide that, okay, instead of purchasing this additional coverage for myself to increase my coverage from 500K to a certain amount, why don't I take that additional coverage on my spouse? So this CEO could take this additional coverage on his or her spouse to the maximum that is allowed or to the maximum units that he or she can afford. Okay. For example, Mario is 55 years old and he recently started a new job. He was automatically enrolled into the company's group life insurance plan last week, which covers him for 75,000. He just took but a new mortgage of 200,000, and he would like to add 200,000 of life insurance coverage to cover his debt if he dies. Because of his health issue, individual insurance will be very expensive, assuming he could even get coverage at all. However, his group life insurance plan allows members to buy up to 10 units of additional term insurance coverage, where each unit is 25,000, as long as they apply for this coverage within 60 days of joining the plan. No evidence of insurability is required, so Mario can take advantage of the group life insurance plan to get the coverage he needs at a more affordable cost. Pretty much straightforward, right? Okay, let's move on to permanent coverage. Now, permanent insurance is sometimes offered instead of term insurance as an additional coverage, but this is rare, very rare. This is more commonly an option for policy conversion. Yeah, it's more of an option for policy conversion. Like when I left GE, I was offered that option to convert my group plan to a permanent personal coverage. But you know what, guys? Yes, I wanted to. I actually met with a representative from Manulife because GE was using Manulife at the time. And oh boy, when they gave me the price, ooh, it was so expensive. It was super duper expensive, guys. Okay. Now, dependent life coverage. Dependents, that is the spouse and children, may be covered without proof of insurability if the plan members applies for their insurance within a short period of time after joining the plan. So this is telling us that some organizations allow coverage for dependents such as spouses and children. Okay, so remember we've looked at permanent coverage, which is rarely seen or available, but is available as a conversion option. Okay. Now, so again, dependent coverage can be obtained within a short period of time after joining the plan. Okay. Upon a change in marital status, coverage can be obtained for a dependent without proof of insurability, again, within a specified period of time. All right. Premiums for dependent coverage tends to be higher than premiums for single life coverage. This is due to higher risk associated with adverse selection. Dependents in poor health who may otherwise be uninsurable may take advantage of the dependent coverage. That's right. So because the insurance company, they are assuming risk that they don't know that may exist or that may not exist. For that reason, additional coverage for dependent may be more expensive. Okay. Now, definition of dependent. So you need to know this one. Okay. Who is a dependent? Can I go and take anybody from my village and say, this is my dependent, so I can put them on my group plan? No, there is a definition, specific definition of who a dependent is. One, a spouse, which could be considered illegal, common law, or opposite sex or same sex. Okay? Children who are financially dependent, the oldest age that may be covered is 18, 19, or 21. Extended coverage up to age 25 is available if the child is in school. Coverage begins 15 days following birth. Now, disabled children may be covered indefinitely. For example, Chooks and Paul both works at the same company, and they are both covered for $200,000 under their employer's group life insurance plan. Chooks is married, but he and his wife do not have any children. Paul has a wife and 2 young children, and they expect a third child in few months. Chooks and Paul both opted to buy the optional dependent coverage offered by their group plan, despite the difference in the number of their dependents. Chooks and Paul will pay the same premium. Also, Paul's newborn will automatically be covered under the plan after reaching 14 days of age. Wow. You see, the thing with group coverage is that once you opt and you select group coverage, it doesn't matter the number of children or not your cover. If you like have 10 children, all of you be covered. And you'll be paying the same premium with somebody that is only him and his spouse, right? Oh, this one is not balanced at all. Anyways, so let's move on to death benefits amount. 632. And sorry, I need to move my notes. Death benefits amount. Okay, let's move on. Now, the death benefits under dependents life coverage is quite modest compared to the coverage on the member's own life or the optional spouses coverage available under the same plan. While the actual amount will vary with the policy, dependence coverage is usually in the range of 5,000 to 20,000 on the spouse life, with 50% of this amount on the life of each dependent children. Okay, that is death benefit. So it's not usually like one crazy big amount like that, like it is on the actual employee. No. Now, premiums, each group plan member with dependents life coverage pays the same amount of premium regardless of the number of their dependents. Okay, like we saw before. Now, the same group plans require separate payment for each dependent. Coverage is very low. That is, coverage of 10,000 for all children may cost $2 per month. Yeah. Same group plan requires separate payment for each dependent. Yeah. Could maybe $2 per month. That's really low. Now, survivor income benefit. We'll move on. Okay, guys. Yeah, I think I've been moving at a very slow pace, so I'll kind of top up the speed a little bit. Now, some group plan provides the option for the survivor of a group plan member to receive a monthly income benefit. The amount paid is a percentage of the plan member's monthly salary before death. And this is normally an optional benefit that can be purchased by the plan member. For example, Richard was a group plan member with AAA Industries. When he dies, his wife receives the death benefit from the AAA group policy, and she will continue to receive monthly benefit equal to 25% of Richard's monthly salary. Ooh, that's interesting. beneficiaries. Now, the survivor income benefit can be paid to the spouse or sometimes the children. The spouse receives the benefit until age 65 or at such a time as the spouse remarries or when the spouse dies. The children receive the benefit to a set age such as 21 or longer if they continue to attend school full time. Benefits amount. As discussed, the benefits the spouse receives is a percentage of the plan member's monthly salary before death. There may be a maximum imposed on the amount the survivor can receive each month, each year, or cumulatively. Surviving children may receive a higher benefit if both parents have died. That is, both the plan member and the spouse, and the child has been orphaned as a result of the plan member's death. For example, a group life insurance plan offered by ABC University allows plan members to buy coverage that will pay monthly survival income benefits equal to 25% of the member's basic salary monthly to the surviving spouse, plus 5% of the basic monthly earning to each surviving child. Accidental death and dismemberment. Okay, so now again, we are looking at benefits amount, and then beneficiaries, and then survivor income benefit. So survivor income benefit is what we've looked at already, where the survivors can get additional income, which could be a percentage of the base salary. Okay, we'll see the benefits amount. It could be to the maximum or specific, whatever. Now, accidental death and dismemberment. Now, if a group life insurance plan usually offers accidental death and dismemberment as part of the group benefits. So death must result from an accident, and the benefit paid is an extra benefit over and above the base benefit. Okay, so remember when we talk about riders and benefits, right? And this AD&D, accidental death and dismemberment, is one of riders and benefits. And what we are learning here is that most group plan offers this, okay, offers accidental death and dismemberment as part of the group benefit, okay, and death must result from accident, okay, and then the extra benefit usually equal the basic death benefit. For example, Michael has been working with Energy Power for 5 years. He's enrolled in the company's group plan, which provides group life insurance coverage in the amount of one-time salary of 55,000. The plan also has additional accidental death and dismemberment coverage. So his wife is the named beneficiary. While on vacation, he has a skiing accident and dies due to his injury. As a result, his group plan pays his surviving spouse a death benefit in the amount of 55,000 plus an additional death benefit of 55,000 under the accidental death portion of the accidental death and dismemberment coverage. Okay, all right. Now, under the dismemberment part of accidental death and dismemberment plan, the insurance company will pay a lump sum equal to a base death benefit or a percentage of the death benefit. It is paid as a lump sum when the plan member loses a body part, okay, or a body function as a result of an accident. So we saw that yesterday. There are percentage amounts that is being paid, okay, when a certain part of the body is lost or a certain function of the body is not, or certain part of the body is not function, simply put, okay. All right, let's move on. Basic versus voluntary accidental death and dismemberment. Basic AD&D is automatic coverage. provided to plan members. Now, voluntary AD&D is optional coverage provided to plan members, often sold in multiple of a specific unit to a maximum amount. Each unit has the same dollar value, such as 5,000. If the plan member dies as a result of an accident, then the calculation for the death benefit is death benefit plus number of units times value of additional units. Examples: Maureen's group life insurance plan provides a death benefit equal to her annual salary of 120,000. It also provides additional death and dismemberment coverage equal to 1 time the death benefit. She purchased 4 units of voluntary accidental death and dismemberment coverage at 25,000 per unit. If she dies as a result of an accident, her beneficiaries will receive a total of 340,000, calculate as 120,000 death benefit from group insurance, 120,000 death benefit from accidental death and dismemberment, and then 100,000 death benefit from additional death portion of the voluntary AD&D plan. However, if she dies as a result of an illness, her beneficiary will only receive 120,000. All right. Now, coverage for dependents. Coverage is for dependents. All right. Coverage for spouse and children of a plan member is optional. Coverage is a percentage of the coverage of the plan member. For example, Charlotte's group life insurance plan provides a death benefit equal to her annual salary of 120,000. She also purchased 4 units of voluntary accidental death and dismemberment coverage at 25,000 per unit. So she purchased, if she dies as a result of an accident, her beneficiary will receive 220,000, calculate as 120,000 plus that's additional 4 units that she bought, okay? However, if she dies as a result of an illness, her beneficiary will only receive 120,000. Exclusions. Oh, sorry about that. Now, we're talking about what? Exclusions. Exclusions. Okay, let's look at that. Death must be caused by an accident for accidental death and dismemberment benefit to be paid out. That's right. Common exclusions to payment of the benefits are injuries that are self-inflicted. Those are exclusions. Exclusion means what will happen and there will not be payment. Okay. So if someone inflict itself with injury, they will not get paid. Injuries that are caused by war or service in the armed forces will not get paid. Injuries that are caused when committing a crime will not get paid. Injuries that are caused by impaired driving. If somebody died from accident that results from impaired driving, isn't going to get paid. Injuries that are caused by piloting a non-commercial aircraft will not get paid. Okay. Overall limits, there will be a maximum number of additional AD&D, okay? Accident and dismemberment. I don't know why I always say addition. There will be a maximum number of accidental death and dismemberment units of coverage that can be bought. That is units of 10,000 up to a maximum of 10 units, which is 100,000, okay? conversion privileges. Coverage under a group life plan may be converted to a personal policy with the same insurance company if the plan member leaves the plan due to retirement or change of employer. That's right. Like in my own case, right? When I left GE, I was offered that conversion options. It's called conversion privileges, even though I eventually did not exercise it, not because I don't want to, but because it was freaking expensive, right? And yeah. Secondly, the group member is no longer a member of the sponsoring organizations. Yeah. So the moment you are outside of that group, yeah, now the sponsor terminates his plan. Again, the sponsor, the employer can say, we are not doing this again. They can change their mind that they are not providing this coverage to any member of their employees again. What can you do? That's it. Example, Derek's employer is experiencing financial hardship and it has determined the group plan to cut costs. Oh, sorry, and has terminated the group plan to cut costs. While Derek may be able to convert his coverage to an individual policy, it will still be considerably more expensive than the group insurance coverage, and he will have to pay the premiums himself. In Quebec, the Quebec Act respecting insurance includes specific rules that protect a group member's right when he leaves a group life insurance plan or when the master contract expires or is cancelled. Okay, leaving the plan in Quebec. We're not doing Quebec here now, but they just want to have us to know this. Okay, let's go. A group life member must be given the option of converting group coverage into personal coverage if the plan member leaves the group before age 65. This also applies to spousal or dependent coverage. Now, the personal coverage is limited to an amount between 10,000 and 400,000. The converted dependent coverage must be 5,000 for each dependent and cannot exceed the amount of insurance on the life insurance, on the life of those persons on the conversion date. The group member has 31 days after leaving the group to convert to the personal coverage for himself, his spouse, and dependents without providing evidence of insurability during this period. The group insurance will remain in effect. Now, the conversion option provided must be a comparable coverage, a one-year term with a further conversion option at the end of the year to convert to permanent insurance. Okay. Moving on to master contracts terminates, that is in Quebec. So again, this section, they are just giving us an idea of when you're leaving a plan in Quebec, what are your options? Now, master contract terminates in Quebec. If a master contract expires and is not replaced, or if the master contract in place with one that provides less insurance coverage, a person who has been a plan member for at least 5 years can convert some or all of his coverage into a personal policy within 30 days after the master contract expires. Okay. The amount of insurance to be carried over to the personal policy must be the greater of 10,000 or 25% of the group plan coverage. So not even everything. Wow. In the rest of Canada, there is no provincial legislation other than in Quebec to specify what happens during conversion of a group plan member to a personal policy. Guidelines are set out by the Canadian Life and Health Insurance Association and have been adopted by the rest of Canada. And these guidelines are conversion of group coverage to personal coverage up to 200,000 should be permitted up to and including age 65 without providing proof of insurability. Now, the plan member should have a minimum of 2 life insurance choices. Insurance choices are yearly renewable term or term to age 65. The application must be made within 31 days of the end of the group plan. Yeah. I remembered when I left GE, the insurance company, they did a fantastic job. They called me like almost immediately. Hey, Joe, you have 30 days or 31 days to make this decision. And then they assign somebody to me, to follow up with me, to explain all the process to me. And yeah, so it can be tough in those moments, right? Now, the Canadian, what is the full meaning of this again? The Canadian Life and Health Insurance Association. So, okay, the Canadian Life and Health Insurance Association guidelines do not address conversion privileges for spousal and dependent coverage. In practice, most group insurance plans extend conversion privilege to spousal coverage. Dependent coverage is not convertible. Okay. Now, premiums upon conversion are, of course, you can imagine. Now, the concept of adverse selection applies to converted policies. That is, those who are most likely to be uninsured or have a higher risk of dying applies for conversion. And this may be because conversion does not require proof of insurability. Therefore, the plan members may receive insurance for which he will not otherwise qualify. All right. Now, this increases the insurance company's risk, and therefore premiums may be higher on a converted policy than on a brand new individual policy. You get what is happening here, right? Which I believe was what happened to me, because you see, when you have that 31 days or 30 days, as the case may be, to convert your policy, you are not required to provide proof of insurability. So again, the insurance company feels that they are taking on a risk that they don't know. So they assume the worst. And by assuming the worst, if their assumption of the worst may be better for those who are in poor health condition that on their own may not be able to get life insurance. However, if you are in good health condition like I am or like I was, it will be freaking expensive for you. In that case, it's way better you get a new policy for yourself. Okay. A replacement contract. A sponsor may choose to change group insurance companies, that is, replace one with another. Now, Canadian Life and Health Insurance Association guidelines. Okay, now I remember it, right? Okay, let's see what they say. Moving my notes, guys. Okay. Guidelines are designed to ensure that members should not lose coverage as a result of such changes unless they were members of a class that is not covered by the new plan. Also, members should not lose coverage because they were not actively at work at the time of the change. All right. So this is happening if an organization is switching from one insurance company to another. Maybe they've been with this insurance company for 5 years, for 10 years, and they feel it's time to move on to another insurance company. Maybe this new insurance company gives them something better, more better pricing and stuff like that. What the Canadian Life and Health Insurance Association is saying is that no employee should be left uncovered during that switch, okay? Except if that employee is not going to be covered in the new plan that they are moving into. All right, I think I've covered everything here. Okay, so it also says that even if the member is not at work, they should still be covered. Maybe their mat leave, vacation, or stuff like that. Anyways, benefit amount. Benefit amount should not change as a result of a replacement contract, provided that the plan member is eligible under the term of the new contract. However, a new maximum may apply. Okay. You see, sometimes the reason why some organization may wish to switch insurance company for several reasons, right? But what this organization is saying is that that should not reduce benefit amount or change it. All right. But they are entitled if they want to change or establish a new maximum. Okay. Disabled members. A waiver of premium is included for group plan members if a plan member becomes disabled. The Canadian Life and Health Insurance Association guidelines requires that the premium must continue to be waived and coverage continues even if the employer terminates the group contract with the insurance company. Requires that the premium must continue to be waived and coverage continues even if the employer terminates the group contract with the insurance company. Really interesting. Now, group creditors insurance. A creditor is a person or a company owed money by the borrower. For example, big bank lends money to homeowners in the form of mortgage. Big bank is the creditor. Most financial institutions offer creditor insurance to their customers. Now, group creditor insurance establishes a financial institution as the policyholder and the people to whom the financial institution lends money as the plan group members. For example, Big Bank is a policyholder and homeowners in the group members is the group members. Okay. Okay. So yeah, in this, when they are talking about big banks here, I want you to look at CMAC, for example. Okay. Now, to protect borrowers, Canadian Life and Health Insurance Association guideline requires the lender to disclose that the insurance they provide is voluntary and cancelable. After receiving the certificate of insurance, the borrower has 20 days to cancel and obtain a full refund. Okay, the borrower can cancel at any time, and the amount of the premium and how it is calculated. The amount of the premium and how it is calculated, coverage is subject to acceptance by the insurer. Any and all limitations restricted or excluded coverage. Terms under which coverage starts if the application is accepted. Any further steps that the borrower has to take. Okay, I think I need to step back. Let's go over this again. Group creditor insurance. Group creditor insurance. A creditor is a person or a company owed money by the borrower. Okay, so the creditor is the person that owes money by the borrower, exactly. So the borrower is the one owing. Then the creditor is the one providing the credit, or rather providing the money, right? For example, a big bank lends money to homeowners in the form of mortgage, yes. So the big bank is the creditor, yes. And then the borrower is the homeowners. Okay. Is it the CMSA that lend money or that provides protection against the money borrowed? I think CMSC, what's the full meaning again? Yes, CMSC is the one that provides the protection, that provides the insurance, is that insures the loan, the mortgage loan. Yes, CMSC insures the mortgage loan. Okay. So now, with that in mind, where we are looking at group creditor insurance, where there's a bigger bank that provides the funds, and then there's a borrower, what are they saying here? So most financial institution offers creditor insurance to their customers. Okay. Group creditor insurance establishes a financial institution as a policy holder, and the people to whom the financial institution lends money as the plan group members. Okay. For example, big bank is a policy holder, and the homeowners is the group members. And the CMSC you pay, if you did not put down up to 20%, is the premium for the coverage that insures the mortgage. You getting it now? Yeah. So each of our mortgages, each of us now, we are plan members in that group. Okay. Now, to protect borrowers, the Canadian Life and Health Insurance Association guidelines requires the lender to disclose the following. So in that case, the lender now is the bank to disclose the following. The insurance they provide is voluntary and cancelable. Okay, so to tell us that the insurance they provide is voluntary and cancelable, that after receiving the certificate of insurance, so you, the borrower, has 20 days to cancel and obtain your full refund. Okay. 3, that you, the borrower, can cancel at any time. 4, that the amount of premium and how it's calculated, okay, is open, right? The amount of premium and how it's calculated is not a mystery to you. It's something that you know about, that is, you understand, is clear to everybody. 5, also that the coverage is subject to acceptance by the insurance. Also that the insurance company is also accepting the coverage, because there are some people that they will apply, they will say no. Maybe they have bad credit or something like that, right? And also that any and all limitations, restricted or excluded coverage, or any limitations at all is stated. Okay. Now also that terms under the coverage starts if the application is accepted. Any terms under the coverage only start if the application is accepted. And also any further steps that the borrowers has to take, okay, will have to also be clearly stated. I think it's clearer now, right, guys? Yeah, because that first time we go through it, it's kind of all over the place for me in those moments. And I wanted, if it's not there for me, I'm sure there might be some of you that are still wondering what this is talking about. So hopefully we've been able to, get better understanding in that aspect. We're almost done with chapter 6. And once we're done with chapter 6, we'll move straight into the question and answer for chapter 6. So stay with me. We move on to death benefits. Okay. Now the death benefit is usually equal to the outstanding loan. For example, homeowners has a mortgage of $250,000. 4 years later, when he or she dies, the mortgage remains 244,000. So the death benefit is what? 244,000. The beneficiary is the creditor. You see, that's why we always tell people that, look, when you take mortgage insurance from the bank, you don't have the right to name the beneficiary. The beneficiary is the creditor. In that case, most of the time is the bank, right? Or the lending institution, which use the proceeds to pay off the debt. For example, the homeowner's debt benefit is 244 and it is paid to the big bank. Premium. Underwriting for creditors insurance is not like underwriting for personal policy. Factors taken into consideration for creditor insurance are age and smoking status. Premiums for mortgage life insurance are based on the total amount of the mortgage. Okay? So this is dealing with mortgage insurance. Okay? It is considered, and that's why the underwriting process is very lenient. It's not as complex. Okay, it is considered decreasing term insurance because the premium will never change, even though the balance is declining over time. For example, homeowners premium will be based on 250,000 mortgage. Now, insuring a line of credit is based on the amount of the loan outstanding each month, or an annual coverage. For example, a line of credit has been extended in the sum of 80,000. If 25,000 has been used, the premium is based on the 25,000, additional coverage. The creditor group policy may also cover critical illness, disability, and sometimes unemployment. It may be part of the base policy or covered separately. Disability. The creditor is paid a monthly benefit upon disability. The amount of the benefit is the lesser of base on a monthly loan payment or a specified amount. For example, Big Bank has provided all forms of additional coverage on homeowner if she becomes disabled and cannot work. Big Bank is paid the equivalent of homeowner's monthly mortgage payment. Benefits may be paid for the entire period of disability or specified period of time. Cumulative maximum may apply to an amount paid, okay? All right, so we move on to critical illness. The insurance will pay off the outstanding balance of the loan if the borrower is diagnosed with a covered illness. The amount will be made regardless of whether the borrower can work or not. For example, Big Bank has provided a personal loan to homeowner. If she is diagnosed with critical illness covered in the policy, Big Bank will receive a lump sum equal to the amount of the loan. Interesting. Okay, so we move on to unemployment. Unemployment. All right. The creditor is paid a monthly benefit. So when we say creditor here, we're talking about the bank, okay? The creditor is paid a monthly benefit to a specific dollar amount and for a specified period of time if the borrower becomes unemployed through no fault of his or her own. Example, Big Bank has provided a mortgage to homeowner. She loses her job because her company is bought out by another. Homeowner is unemployed for 10 months and begins work again in the 11th month. Big bank receives a sum every month for 10 months from the group creditor insurance. In month 11, homeowners resumes her mortgage payment. Okay, group life insurance versus individual life insurance. So yes, we're going to be looking at, this is a table that shows us, more or less like group insurance, individual life, okay? Now, in a group life insurance, okay, the company controls under the control, who has the control of the policy? Well, the employer or the plan sponsor owns and have the control of the policy. For individual, the policy owner owns and controls the policy. Now, when it comes to evidence of insurability, under the group life insurance, generally, there are no evidence of insurability during the eligibility for enrollment period. However, for individual, evidence of insurability is required. Now, when it comes to premium, excuse me, premiums are based on the makeup of the group, not gender, not health, not age. Okay, it's made up of, it's based on the composition, the makeup of the group. However, for individual, it's based on your gender, your age, your health condition of that individual. Now, people with poor health condition under the group plan, okay, are able to get coverage at affordable rates. However, people in poor health condition will be denied coverage or will pay a higher premium if they were to be getting life insurance coverage for themselves and by themselves. Now, guaranteed premiums. Well, when it comes to group life insurance, premiums are only guaranteed for 1 year at a time. Okay. However, for individual policyholder can choose yearly renewable term coverage or 5 years or term 20 years, etc. All right. And now when we look at coverage rarely continue past age 65 when you are in a group plan. You see, this is because 65 is the end of active work life in Canada. Okay. However, for individual plan or permanent, it can continue up to age 80. Okay. So you can obtain term insurance up to age 75 or 80 or permanent coverage until death. Okay. Now, base coverage for group plan amounts are dictated by the plan and optional coverage is usually limited. However, for individual, you do you, right? Your coverage can be customized to your individual needs, okay? Now we'll move on to talk about advantages and disadvantages of group life insurance. What are the advantages? Well, the advantage of group life insurance is that no evidence of insurability for people in poor health condition or people with pre-existing condition, people who smokes, ordinary will not be covered with affordable premium, okay? Now, disadvantage is that people in very good health who pay the same premium as the rest of the group. So in other words, there's a lot of robbing Peter to pay Paul going on within the group plan, right? Now, second point is some or all of the premiums may be paid by the employer. However, in the disadvantage is that the employer or the plan sponsor controls the plan and can make changes without consulting the plan members or the group members, okay? It is convenient for the employee, of course it is, and then the amount of coverage may not be what the plan members need, okay? Coverage may be converted to individual coverage without proof of insurability if the policy terminates or the members leaves the organization. However, the disadvantage is that the premium for the individual coverage upon conversions are not guaranteed and may not be favorable, could be freaking expensive, right? Now, the employer paid premiums are a taxable benefit to the employer. All right. Oh, you survived chapter 6, did you? I'm glad you did. And that brings us to the end of chapter 6. And then we are moving on to Q&A for chapter 6. Okay. Because I'm not sure if you guys are seeing my screen right now, and the way to be sure of that is just for me to stop sharing and reshare again. That one, I avoid the risk of having to finish everything and only to realize that, oh my God, he did not switch. Anyways, let's see, how many questions do we have here for chapter 6? Woohoo! We've got 30 questions. Well, we're going to go through this process, this journey together. I don't know everything, okay? But we're going to put in our best. But the most important thing and the whole essence of this exercise is how we interpret questions and then the options, right? Now, which portion, question 1, of accidental death and dismemberment coverage does the insurance company pay an extra benefit over and beyond the regular death benefit if the plan member dies as a result of an accident? A, survivor income benefit, health insurance, accidental dismemberment, accidental death. Let's read the question again. Which portion of the accidental death and dismemberment coverage, we know what that is, right? Does the insurance company pays an extra benefit over and beyond the regular death benefit if the plan member dies as a result of an accident? So now this person dies over and beyond. If they are said that this person loses a function or loses a body part, it would have been an accidental dismemberment. But because this person dies as a result of an accident, I'm going to go with accidental death. I'm freaking sure this is going to be right. You got me? But you see what they're testing. It's not survivor income benefits. Wait, okay, yes. So yeah, it's not survivor income benefit, it's not health insurance, okay? These two are now using elimination method, this first A and B is the two wrong answer. The right one is between C and D, but because this person dies from death, it's accidental death. If they are said and this person loses one right arm as a result of accident, it would have been an accidental dismemberment. You got it? Good. We'll move on. Okay, question number 2. When adverse selection applies, who is more likely to convert their group coverage to individual coverage? See, adverse selection is where somebody in poor health condition who ordinarily on their own wouldn't have been able to get life insurance or pay a very high premium were able to get life insurance because they were a part of the group. They are the first to run and convert because they are not within that 30 or 31 days. They are not required to provide proof of insurability. Now, every time you hear proof of insurability, this is referring to prove that they are in good health. Okay, so when you see proof of insurability is evidence that they are in good health. They don't require to provide evidence that they are in good health. So let's see, someone who has a broken arm, someone who has a higher risk of dying, someone who has a common head cold, someone completely healthy, not someone completely healthy, someone who has common head cold, no. So I've eliminated C and D. Now let's look at someone who has a broken arm or someone who has a higher risk of dying. I think it's going to be someone who has a higher risk of dying, okay? They are the ones that will likely, convert their group coverage to individual coverage. Who is likely? Who is more likely? More. Okay, so we move on. You got it? But don't worry. We'll see the answer. We'll see whether it's right or wrong. Okay? Now, let's just enjoy this process. Let us not be carried away by, let's enjoy the process. Let's learn together right here. Okay? Now, which insurance tax is built right into the price quoted by the insurance company for premiums? Which insurance tax is built right into the price quoted by the insurance company for premiums? Provincial tax, community tax, state tax, federal, it's provincial tax. Okay. And the good thing I love about this exercise is that by the time we review the answers, we're going to see the rationale, right? And I love when we see those rationales because it drives in deeper the understanding of the concept and the principle, okay? What do some employer sponsors group have more than only one under a single group plan? Let's take that again. What do some employer-sponsored groups have? In other words, what do some employer-sponsored group have more than only one of under a single group plan? Membership classes, group members, premiums, master contract. Master contract is just one for every plan sponsor. It's just one. So you don't get to get more master contract for any specific reason. What do some employer-sponsored groups, employer-sponsors groups have more than only one of a single group plan? So what I'm deducing from this question is that you remember how we talked about the way some organizations may group their members into groups, right? Section their members into groups, right? Where you have the managerial groups, then you have the admin staff groups, and then you have the workforce, the laborers, the boots on the field kind of groups, right? So I want to believe that this is what this question is testing. Now, what does some of these sponsored employer groups have more than the other single group plan? Single group plan is a single group plan where it's a leveling ground. Everybody get the same thing. Everybody is, is leveling ground for everybody. Well, will it be a membership classes, group members, premiums, master contract? What do they have more? It's not master contract. Master contract is one, regardless of the membership classes in the group. Premiums, group members, or membership classes. I'm going to say membership classes. You see, because when they have more groups, and those groups are groups into membership classes, right? Like the managerial and anyways. So we'll see. Okay, guys. What is the most common schedule of benefits? The most common. How do we know? What is the most common schedule of benefits? Earnings multiple, length of service, flat rates, or combination? Wow. How do we know the most common combination? You see, you can see combination of earnings, length of service. You know what? I just want my guts is telling me this. I'm not sure combination, but we'll see. Don't worry. We're gonna see. All right. Which schedule do some employers opt for that incorporate factors such as earnings and position? Flat rate, combination, length of service, earnings multiple. Which schedule do some employers opt for that incorporate factors such as earnings and positions? Not flat rate. Combination, length of service. Ooh. Which one does employer opt for that incorporate factors such as earnings and positions? That incorporate factors such as your earnings, not flat rate, no flat rate, everybody gets the same. Combination combines length of service, any multiples. That's combinations. Or is it for only length of service? No, somebody position sometimes is not determined by length of service, and earning sometimes may not be determined by length of service. So I will be leaning towards these two, either combination or any multiple. Earning multiples. So I'll go with earning multiples. The reason why I'm going with any multiples, remember the example they gave us where they say that as the CEO will get double, and then the factory worker will be double their salary, 2 times their salary, and the factory, the both on the field, the guys actually doing the work will get 1 time their salary as the benefit. So that's on that ground. But again, guys, let's just go through and trust the process. Let's enjoy the ride. Okay, we'll get there. All right. Which insurance plan has the right to convert some or all their group coverage to individual coverage with the same insurance company? Group health insurance plan, individual life insurance plan, dependent life insurance plan, group life insurance plan. Oh, sorry. The first one is group health insurance plan. They say which insurance plan has the right to convert some or all their group coverage to individual coverage with the same insurance company. With the same insurance company? Which insurance plan has the right to convert some or all their group insurance to individual coverage with the same insurance company? Group health insurance plan, individual life insurance plan, dependent life insurance plan, group life insurance plan. I'm going to go with group life insurance plan because we've not even done health insurance yet. So anyways. Yeah, I'm going to go with that. Okay. Question 8. Which option is the ideal number of people with a common characteristic to be insured under a group life insurance plan? Which option is the ideal number of people with a common characteristics to be insured under a group life insurance plan? Sufficient, single, half, or which option is the ideal number of people? Sufficient, single, half. I have to be insured under a group life insurance plan. Sufficient, single, half. Let's just go with all. We'll see. Which group creditor insurance will pay the lender a monthly benefit if the borrower loses his job through no fault of his own? Okay, this is talking about disability benefit, right? Group creditor unemployment insurance, group creditor employment insurance, group creditor critical illness insurance, disability insurance. Which group creditor insurance will pay the lender? He has told us that it's a group creditor insurance. A monthly benefit, the borrower loses his job due to no fault of it. Group creditor unemployment insurance. Group creditor employment insurance. A group creditor critical illness, disability insurance. So which group? So this is which group creditor insurance? So it's group creditor employment insurance, unemployment insurance. So it's between this A and B. Disability is if the person loses income due to sickness, right? But this one is due to loss of job, so it's not disability. Group creditor critical illness is not critical illness because it's not due to sickness or anything. So now it's between group creditor, is it unemployment or group creditor employment insurance? I'm going to go with employment insurance because, like we see EI, right? It doesn't say employment insurance. It's not employment on insurance, right? Is employment insurance. So I'm going to borrow that idea from EI, bring it in here, and I'm going to go with group creditor employment insurance. You feel me? You feel me? Awesome. Okay. Don't worry. We're 20 answers away from finding the truth. Mark it down, question 9. Okay. Okay. Now, at what age is the survivor benefit still payable to the plan member surviving spouse or common law partner still? Age 65 for the most part, because most of all these benefits ends at 65, which is the end of active work life. Okay. All right. Which one is an example of a dependent? Spouse, parent, boss, co-worker? Is your spouse is a dependent? All right. To keep costs reasonable for the group, what type of members will this schedule reduce coverage for? Members' parents, members' children, old or retired members, young and new members, old or retired members, because these older members and retirees are forces the price of the premiums to significantly go up, because the older they get, the more the risk of dying, and then the more the cost of insurance. Okay. All right. What do most life insurance plans place on the coverage for any single plan member when the coverage is a multiple earning for highly paid employees? Minimum, level, cap, nothing. It's cap, right? You see, so when an employee is a highly paid, like you remember the example of a CEO, if the coverage is a multiple of earning, for example, if the CEO, earns let's say 200,000, right? And this by in some years' time, the CEOs and when the CEO is earning 200,000, so let's say the debt benefit is 2 times the earning. So if anything happens, the CEO will get 400,000, right? The beneficiary will get 400,000. Maybe after some years, this CEO's salary may become 300,000, which will force the debt benefit to now become 600K, right? So an organization with this kind of situation may put a cap and say to the maximum of maybe 500. So even if the annual salary of this CEO gets to 300, subsequently, the debt benefit can only be 500, not 600, okay? And that is a cap we're talking about. All right, question 14. What is paid by the employee that is not deductible to either the employer or employee? What is paid by the employee that is not deductible to either the employer or employee? A, master contract, no. Sales tax, no. Premium, I think it's premium, or member classes, because the premium, what is paid by employee, so what is paid by employee is not by employer. So the premium paid by employee is not tax deductible to the employee, neither is it tax deductible to the employer. Okay, that's what I'm going with that. So again, mark it down, question 14. We'll see. All right, question 15. What do financial institutions encourage borrowers to obtain to cover the debts they have with their financial institution? Individual health insurance, no. And RRSP, no. Health insurance, no. Life insurance, yes. What do financial institutions encourage borrowers to obtain to cover the debts? The debts here is DEBTS they have with the financial institution. I think it's life insurance, individual health insurance, no, RRSP, health insurance. Okay, moving on to question 16. If an employer pays some or all of the premiums for a group life insurance plan, which expenses are those premiums deducted as? Ooh. If an employer pays some or all of the premiums for a group life insurance plan, which expenses are those premiums deducted as? Luxury, business, mortality income, business expenses. Yeah, they are deducted as business expenses. What is the total amount of coverage subject to underarm coverage? What is the total amount of coverage subject to oh, sorry guys. Okay, let's take the question again. What is the total amount of coverage subject to under term coverage? A, total amount, base amount, maximum amount, minimum amount. What is the total amount of coverage subject to other term coverage? Total amount, no, base amount, no, maximum amount. I think it's maximum amount. Under term coverage, the total amount is subject to maximum, I would think. Yeah. Okay. Question 18. Which schedule intends to reward long-serving employees? Flat rate, no. Length of service, I think so. But let's look, earnings multiple, no. You can earn multiples even when you haven't stayed in an organization for a long time. Combination, that was the length of service tends to reward, employees that have been in an organization for a long time. All right, question 19. What type of maximum does the group plan place if the voluntary accidental death and dismemberment coverage is available in multiple of a fixed unit? What type of maximum does a group place? Well, single limit, no limit, overall limit, and cap. I would say cap. What type of maximum do they put? They put a cap of the multiple. No. Overall limits, right? What type of maximum does the group plan place if the voluntary coverage is available a multiple of a fixed unit? If it's a multiple of a fixed unit, then we'll be looking at, is it single limit? No. Is there no, there's a limit, overall limits. So I would say it's overall limits. Okay. We'll see again. This is question 19. Which benefit is normally expressed as a percentage of the group members' monthly salary just prior to death? Okay, yes. So is survivor income benefit? Yes, that's the answer. Then let's look at, is it health insurance? No. Accidental death and dismemberment premium? No. Is survivor income benefit? Remember, this is the percentage that is being paid to the survivor. Okay, it may be 25. This is, again, know that this is an addition to the death benefit. So let's say this survivor earns 5,000 a month, and if this is 25%, so it means the beneficiary or the spouse will be getting 25% of this 5,000 up to that person's age 65, or depends as may be stipulated in the contract. Okay. All right. 21. Which group creditor insurance will pay off the outstanding debt if the borrower is diagnosed with covered illness? Critical illness insurance, employment insurance, old age security, disability insurance. I see a lot of principles going on in all these options for answers. However, the answer is critical illness, and I'm going to explain. They are asking of which group creditor insurance will pay off the outstanding debt if the borrower is diagnosed with covered illness. So it's critical illness, okay? Now, employment insurance is if the person loses their job due to no fault of theirs, okay? Old age security is the government social benefits program that is given to elderly people of very low income, and there are criteria and eligibility for that. And disability insurance is where you are not able to pay due to sickness, due to unable, due to as a result of disability, you are disabled, you're not able to walk or something like that. Okay, so and that's why it's critical illness. All right, 22. what's happening to me sometimes is as I'm reading the questions, I'm at the same time reading answers. Does that happen to you? leave, leave your answer in the comment section. Are you trying to read the question at the same time? Your eyes is staring at the options for the answers at the same time. All right. And if you feel this class is adding value to you, yeah, can you leave a comment, and also don't forget to subscribe as well. Okay. Now, what must be maintained with the group plan member in order for the sponsoring organization to continue coverage over time? Membership, contract, policy, premium is membership. You see, you have to continue to be a member in the group plan. What must be maintained? You need to maintain membership in the group, in what am I saying? What must be maintained with the group plan member in order for the sponsoring organization to continue coverage over time? So they need to maintain membership. It's not contract. It's not policy. Premium. Because members need to maintain premium. So now, see, that's the thing. The answer is between A and D. So to maintain membership or maintain premium in order for the organization to continue coverage over time. You see, they're already members of the plan, right? You see, what must be maintained with the group plan members? So they're already members, right? Is premium. I would say premium, but again, note it down. Question number what? 22. Next question. Which coverage is the more common option upon policy conversion? Term, optional, additional, permanent. I would say permanent, because when people are converting, they know that, look, let me just do permanent now that I'm not going to have to provide insurability, So just, I would say permanent. Again, we'll see. 24. Which one is often referred to as the plan sponsor? Oh, group members? No. Premiums? No. The policy holder. You see, the policy holder is the plan sponsor and also the policy holder. Okay. The master contract is the policy that the contract sent to the company, who is the policy holder and the plan sponsor. All right. 25. Under which schedule does every group members receive the same dollar amount of life insurance coverage, regardless of their position, salary, or wages? This is a level flat rate. Any multiple? No. Any multiple is when they give you 2 times your salary, and everybody is not on the same salary, obviously. So definitely not any multiples. Combination, no. Length of service, no. It's a flat rate. It's the one that levels everybody, put everybody in the same. You feel me? Okay. Next question is loading. What's happening? My screen is blank. What's going on? I was wondering, oh my God, let us not lose everything we've worked for for the past several hours. Oh my goodness. Anyways, which group creditor insurance will pay the lender a monthly benefit if the borrower becomes disabled and is unable to work due to disability. See, disability insurance. I think that's the answer. Not employment insurance. Employment is when you lose a job due to no fault of yours. Critical illness, when you are not able to work due to illness that are covered. Unemployment insurance. It is disability. See, anytime you see disability, is income replacement or payment due to the fact that one is not able to work as a result of disability. All right. Next question. 27. Just 3 answers away from moment of truth. Okay. Which life insurance is coverage that is offered by a plan sponsor to people who have some form of common association with that sponsor? Common association with that sponsor. Group, universal single. It's group now. It's group now. That is all we have been talking about in this chapter. Common association. What is the one additional requirement that the employee must maintain for the employer-sponsored group to get coverage? What is the one additional requirement that the employee must maintain for the employer-sponsored group to get coverage? Never at work, no. At work 1 day a week, no. Actively at work, occasionally at work. What is one additional requirement that the employee must maintain for the employer-sponsored group to get coverage? Never at work, it can't be. At work 1 day a week, actively at work, occasionally at work. I would say actively at work. Okay. Again, I'm going to note this down because of the way this question is worded. I'm very curious to see the rationale. Okay. We'll move next question. 29. What is the accidental death and dismemberment package referred to as if the plan gives the members an option of buying accidental death and dismemberment coverage? So what is this package referred to? If members are able to buy additional coverage of this: basic, involuntary, voluntary, complete. I think voluntary, like you choose, is optional for you, gives the plan member option, is optional, so therefore it's voluntary. Okay, let's see. 30, the last question. Which portion of the accidental death and dismemberment coverage does the insurance company pays a lump sum if the plan member loses a specific body part or body function as a result of an accident? That is accidental dismemberment now, right? It loses, this is it, loses the plan member. This is the loses a specific body part also, yeah. Okay, no health insurance, no survival income, not accidental death. If they are saying dies, it would have been an accidental death. Okay, finish our turn. Let's check through to be sure that we have answered all the questions. And if you notice there were, one that is not answered, to say tell you not saved, then you can just click here, return to attempt to finish that off. And now we are going to submit. How many did we miss? That's a good one. We missed 5. We scored 25. Oh, woo. Look at that. So we did this on this date. Time we did it for 38 minutes. We scored 25 over 30, 93%. Very well done, almost perfect. You can try again for 100. Oh. See, question 1, we got that again, like we always do. Our way of doing this review thing, right? Because I've already read it, back to back, up and down and all that. So we're going to be scrolling through. But anyone we didn't get, we read the rationale. But again, if you want to read this again, let me try to fit it into one page to make it easier for you. Pause it, read it. Most importantly, I'll recommend reading this rationale. Pause it, read the rationale, okay? Because that will drive in deeper your understanding, okay? We're going to scroll through. If you want to read in the rationale, you just pause it right here. That's good. That's a good one. I got that one. This is question 5. Really? What is the most common schedule of benefits? Oh, we say combination. They said earning multiple. The most common schedule of benefit is an earning multiple schedule, which provide coverage equal to a multiple or fraction of the member's base salary. Now you have it. Okay. Again, we failed question 6. Which schedule do some employers offer that incorporate factors such as earnings and position? Oh, okay. So the other one we say combination is all right. Okay. So anyways, read the rationale here. We got this one. Read the rationale, please, so that you can. Wow. Which option is the ideal members of people with a common characteristic to insurance under the, okay, we say all, they say no. Oh, sufficient, really? Almost any group that has a sufficient number of people with common characteristics can be insured under a group life. Oh, sufficient. Okay. It's like back to back to back. Anyway, so which one is this one? Which group creditor insurance will pay a lender a monthly benefit? Did the lose the no tutor? Okay, that one we say group creditor employment insurance. They say no, it's unemployment insurance. Really? Oh my God. I remember. Okay, this was question what again? Yeah, this was question 9 that I said we should note it down. I was saying, let me use my idea of EI. Oh my God. Okay, so now you have it. Please read the rationale. Question 10, we got that, and here's the rationale. 11, we got that, here's the rationale. 12, we got that, and here's the rationale. And 13, we got that, and here is the rationale. 14, we got that, and here's the rationale. 15, we got that, and here's the rationale. 16, we got that, and here is the rationale. 17, we got that, and here's the rationale. 18, we got that, and here's the rationale. 19, of course, we got that, and here is the rationale. 20, we got that, and here is the rationale. 21, good, the rationale. Okay, 22. Yeah, remember I told you guys to also note this down, right? What must be maintained? Like we're saying, they already plan members. So what was it? Membership. Oh my God. I mean, they have to maintain membership. Okay. Now you have it. Please read this rationale. 23, we got that. And here's the rationale. 24, we got that. And here's the rationale. 25, we got that. And here is your rational. 26, good. And the rational. 27, good. And rational. 28, good. Rational. 29, good. Rational. 30, good. Awesome, awesome, awesome. And that has brought us to the end of this class. We've successfully completed chapter 6 and chapter 6 question and answer all in one class. Thank you very much. You keep it moving, and I will see you in the next class where we will be taking on chapter 7. Thank you very much, and have a